The VIX, it's closing in on all-time lows. Welcome to Trading Nation. Today we've got Eddy Elfenbein. He's with AdvisorShares, and Craig Johnson is here from Piper Jaffray. Eddy, let's start with you. You look at the VIX, you look at realized volatility, however you want to put it, it's just very low.
Eric, this is unprecedented. The VIX today, there's a good chance it could close at the lowest point that's even on record. You know, we're going to go 22 straight days without the S&P falling by more than 0.3%. These are of the longest streaks we have on record. And with this, as far as playing it, there's really nothing profound to say about this. Just say locked into your positions, and I would avoid sort of becoming a volatility jockey, because when we see this low volatility, the volatility wants to go somewhere. So that's why I think we're seeing trades like Bitcoin. It's almost the mirror image of it, because people have to chase that drug somewhere. So I would encourage people to not chase the volatility, stay locked into their stock positions. This is really a Goldilocks moment for the stock market.
But so Craig, what does this mean though? Like, why is vol so low? What is that telling you about the investor right now?
Well, Eric, it tells us a lot of things. And first, I'll just mention this is, when you go back and you look at history, there's a lot of interesting things that we need to learn from. But when you ask some of the traders that were around in the 50s and 60s and lived through this era, one of the things they'll tell you is that the most difficult market they faced wasn't the crash of the market in the 1920s. It was actually in the 1950s. The market just kept working. It was narrow, and it just kept grinding higher. Everybody thought it was expensive, and it was really an asset allocation shift that was happening. Money coming out of fixed income, going back into equities that just kept propelling and moving the market higher. Now, Eddy talked about very low price movement. When we actually go back and look at the S&P 500 and look at a peak to trough 2% pullback, we've now gone about 55 or 56 weeks without seeing a 2% peak to trough pullback. We've seen 5 other times in history where this has occurred, and some of those periods were back in the 1950s, also in around 1994, and it's also in the 60s. The point that I'm going to make with this, that was when we were in the early days of very big secular bull markets, and that's where I believe that we have been in, and really we've been making this call since 2012, and we think it's going to continue from here. Now, when you look at the chart of the VIX specifically that we brought in, this is a longer-term chart. There's one observation I would just make about the VIX, is that tops tend to be processes. They don't make single-point events. Bottoms are single-point events. So when you think about the VIX, it can stay low and has stayed low for extended periods of time, 2, 3 years. So trying to use this as a timing gauge for a top of the market, in my opinion, is a mistake. I'd rather use a new highs indicator. I'd rather use some other tools like that. So at this point in time, stocks in motion are going to stay in motion until there's some sort of other force moving the other way. And clearly it's not geopolitical at this point in time, and there's no big structural changes in the market. I'd stay long this tape at this point, Eddy, despite the low volatility.
Thanks, Craig. So Eddy, what do you think about what Craig mentioned, how in the past, in the 50s, it was this big asset allocation shift? Do you think that's what's going on right now here?
I think that's part of it. I mean, also it's a good thing to win a world war and have this broadly, post-war economy. I think what's going on is that people see volatility as sort of the stock market's blood pressure, and I don't think that's quite right. I think the volatility is down because stocks are up. They see that volatility as sort of this gnome that's above and apart from the stock market. Rather, it's just that we're in a very good point right now for the stock market, for the broader economy. We've moved past the financial crisis, and this is a good long-term shift. As Craig mentioned, historically, we have to place in that context. This is a very good point for stock investors, and like Craig said, don't overthink this. This is a great time to be in the market, and just stick with your positions and don't chase volatility.
All right, well, Craig, I was going to ask you another question, but Eddy said not to overthink it, so I think we're just going to leave it there. My thanks to Craig and Eddy for joining me here on Trading Nation. I'm Eric Chemi. We'll see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.